Robert Kiyosaki said, banks lend you money when you don't need it. Now, maybe that's been your experience, that when you actually needed money, you couldn't get a loan from a bank. But then when you didn't need a loan, they were wanting to do business with you then. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today's discussion is going to be about banks, conventional banks, the infinite banking concept, and why we should not do business with banks. Now, let me preface by saying that I know, because I have friends who are local bankers. They work at the local conventional banks and credit unions and such. They are wonderful people. What I'm focusing on is what Nash addressed, R. Nelson Nash addressed in his book, Becoming Your Own Banker, which is the idea that when banks loan money, that money is created out of thin air. It didn't exist prior to us signing that note. And that they're creating money out of thin air and making more money on that. And that is evil. That's what Nash said. So let's begin by talking about what are banks. Now, I want to go really basic here for a second, just in case this is the first video that you've ever seen or the first podcast that you've ever listened to about this idea of becoming your own banker. But also for our clients and prospective clients. This is good information. Consider what a bank even is. And let's look at some other areas in life. River banks, snow banks, food banks, blood banks. So a bank is simply a place where something is built up, where it is amassed. And then, of course, conventionally, banks are places where deposits are made and loans are made, where money is coming in and out. Okay? So food at a food bank, river banks, blood banks, you get the idea. Now, I think the next appropriate question is to ask then, okay, when it comes to conventional banks, whose are they? Who actually owns any given bank, any particular bank? I think that's a valid question to ask. Well, who owns this place? Because somebody does. And because somebody is the owner, that's going to lead us to some other questions and other implications. And ultimately, we arrive at what Nash called the problem. So what is the problem? So again, I open this by saying that Nash said that what banks are doing, again, not the bankers, not the beautiful, wonderful people in our communities, but the banks themselves are loaning money that doesn't exist and charging us interest on it, seeing if we qualify at their terms and conditions, charging us interest, and they're receiving repayments with interest and profits on money that didn't exist prior to that note being written. And that is evil. Now, how do we know this? Well, can you do that? Can you make money appear, you yourself or me? Can we make money appear out of thin air and lend it to others and then have them pay us that back? The principal, the interest, the profits, all that we're earning there out of thin air? No, that's illegal. But banks are doing it. That's the problem. And there are so many layers. There are so many implications. There are so many circumstances that are caused by that root issue right there of money being loaned out that didn't exist. Whether you're looking at the micro level, which is, okay, well, here we are talking about, and let me clarify I'm not talking about savings accounts. I'm not talking about checking accounts. I have savings accounts. I have checking accounts at banks and credit unions. What I'm saying is when I say don't do business with banks, I'm saying, why would we finance our homes, our cars, our college educations, business equipment, braces, vacations. I mean, all the things that we do. Let's just consider whether or not we should do that business with banks. Again, we've asked who owns them. And let me interject here. Aren't banks the nicest buildings in the nicest parts of town with the best kept grounds and the most beautiful people dressed inside that are paid to run the day-to-day actions? Who pays for that? You and me. Who owns it? What does it look like? And now what's the problem? All right, so loaning money that doesn't exist, quantitative easing, fractional reserve banking. These are terms that when you dive in on Austrian economics and sound money solutions and infinite banking, these terms, I just want to say, quantitative easing, fractional reserve banking, the banks are loaning out multiples of our deposits. Okay? Follow me on that. We deposit a certain amount. Let's call it 1. We're not going to get above third grade math here. Let's say I deposit $1. A bank can then loan out a multiple of that dollar. Money created out of thin air. And they're going to charge interest on that thin air money that they've loaned out. They're going to receive profits on that. The bank owners are going to receive dividends because they own the bank. And banks are profitable if they're in existence. I mean, that's what they're there for, is to be profitable. Now, banks can also, even the best business in the world, Nash says, can be run in the ground. And I think it's the First National Bank of Midland, Texas, that he references. So when he's talking about being an honest banker. So even banks can go out of business, and they do. Maybe you've even experienced that. I've seen banks in our local town go out of business, branches closing. However, this fractional reserve banking, this quantitative easing, is us depositing a certain amount and then multiples being lent out elsewhere that doesn't exist, or at least it didn't until we collateralized that or signed that note, of course. And that's going to be a good point right there. Who fronts the collateral? Who fronts the collateral for business that we do with the banks? See, if there's a mortgage on a home, well, the home is the collateral. If there's a car note, well, the car is the collateral. So it's the individual that fronts the collateral. It's the individual that has to acquiesce to the terms and conditions of the commercial bank. It's the individual that has to submit their 2 years of financials for being scrutinized to see if they qualify. It's the individual that's going to be paying all of those interest dollars. It's the individual that's paying for those beautiful people that are in that beautiful building, surrounded by those beautiful grounds, etc. And they're on every towns and counties and city street corner. So those profits, those dividends, they're going somewhere. Again, that goes back to the owner. Let's talk about fees. If you want to see some interesting numbers, start looking up just how much banks earn in fees that they charge on an annual basis. I'm just saying, who pays for that? Seeing whether or not you qualify, that's good times. That's fun. What my experience has led me to is I loathe the idea of wasting my time, because I value my time highly, personally, exposing myself to someone else's scrutiny to see if I qualify for, well, most anything, so that I could qualify to pay them interest, to pay them profits. It's an interesting thing. It's an interesting thing versus making a phone call to access my capital on my terms, and I set the repayments All right, I get to even choose if there's going to be a repayment. Now, again, I've already talked about being an honest banker. The 3 rules of banking are pay yourself first, pay yourself with interest, and then recapture that back into your own system. So I'm not saying to be a dishonest banker. I'm not saying to steal the peas like Nash says. But the point is that those decisions are made by the owner of that bank. So now I'm talking about a privatized banking system, which is built with whole life policies from a mutual company that pays a dividend. So I own multiple policies with multiple companies that form our banking system. And I say banking system because, Nash says in his book that he's not talking about just one policy. You're not going to satisfy your entire need of finance in your life or your business or your investing with one policy. And again, looking at conventional banks and looking at filling that role for ourselves in life, well, those banks have multiple branches and multiple locations. So my wife and I, we own multiple policies with multiple companies. And we get to make those decisions on the repayments and the terms, and we get to do that in a known interest environment. And we're doing that with assets that are not exposed to market volatility. So with a phone call or an email or a one-page signed document, I can have access to the capital that I've amassed on my terms. I just simply ask myself, well, do I want to access and leverage the cash values in these policies or not? And then we do. So that would lead me to also talking about the opportunity cost of real money. So when I pay premiums to a policy that I use as my bank, when I pay premiums to a policy that I own, that's real money. Now, I'm not trying to get into the conversation of, is it a fiat currency? It is, but what currency isn't? So that money didn't come out of thin air. That was from my assets, my incomes, what have you. That's real money. And there's a real cost to that money. And the insurance companies, the money that those profitable insurance companies, those long-lived insurance companies have, that is real money. They're not doing what the conventional banks are doing, receiving a certain amount in premiums and then making loans of what they don't have. That's real money, and real money has a cost. And I know that there are folks out there that would like to talk about, that's where the insurance companies get you, is they charge you interest for you to be able to use your own money. Not so. Insurance, when you make a policy loan from an insurance company, because you're a policy owner, you own a policy with that mutual life insurance company, they're making you a policy loan from their general account. And where can you borrow money without an interest being tied to it? So you're leveraging your cash values in the policy that you own as part owner of that company, and you're giving a policy loan from the general account of that insurance company. So you're not paying interest for borrowing your own money. You're using the life insurance company's money. And again, going back to the terms and the control, when you make a policy loan, you can pay that back or not pay that back. And again, I'm not saying not to pay it back. Be an honest banker. Pay yourself first, pay yourself with interest, recapture the money. Pay that back, pay it back with interest, because you enjoy the profitability of that company. You're part owner in that company. And who wants to see, a company profitable more than the owners? Probably nobody. So when we're paying interest, when we do pay interest, we're paying interest for the overall profitability of that company, wherein we enjoy dividends. So mutually beneficial. However, the insurance company's not calling you. The insurance, from the get-go, they're not even asking you what the policy loan's for. They just ask you how much of it do you want sent and where. So you decide when you pay that back, how you pay that back. Me, I would rather pay more interest than even what the insurance company would ask, because again, that's just more capital to my system. That's more capital to my system. So we're in control of all of those terms and those conditions, and we should be paying interest there because there is a real cost to that money. What did it cost the bank to make money out of thin air? I don't know. But it was made out of thin air. That's why it's evil. That's why it's wicked. You can't do it. I can't do it. It's illegal. But the banks are doing it. Because the government allows them. Well, that's going to go too far in the deep end. Hey, read some good books. I suggest that you read Becoming Your Own Banker by R. Nelson Nash. I suggest that you read Building Your Warehouse of Wealth, also by R. Nelson Nash. And then there's a third book called How Privatized Banking Really Works. And that's with Nash, and that's with Carlos Lara and Bob Murphy. Incredible read. Worth reading. Study up on it. Because the macro level is that if we could take a 30,000 foot view to evaluate why and how do we experience inflation, for example. Again, when the banks are loaning money that doesn't exist, and that's creating repayments with interest from money that didn't exist. And then when we realize that, again, deposits, money that comes into the bank is a liability. It's only an asset to them if they loan it back out. So are you beginning to visualize with me that more money is coming into the banks? Therefore, because they're practicing fractional reserve banking, quantitative easing, they can lend out multiples of what they're getting in deposits. That's growing and scaling in a negative way. And if you want an idea of what this means for us, look up the U.S. debt clock online. Go check out, and you can see individual states even. You can see where individual states are at in their debt. You can see where the United States is at. And, just evaluate over the course of time how that's come about. Look at what the debt was, no matter when you're listening to this, no matter when you're watching this video. 12 months ago, 24 months ago, 4 years ago, 10 years ago, 20 years ago, 50 years ago. It'll be really interesting to see that graphically represented, is what I'm saying. Because I've seen and read and heard that perhaps 80% of the U.S. debt has been created in the past, let's say, 2 years at the time of this recording in 2022. Now that's pretty interesting. But I'll put that on your desk at this point and say continue that study for yourself. Now, in discussing why not to do business with banks, we don't own those banks. We don't control those banks. We don't profit from those banks. What they're doing is deplorable. But we can learn a lot from banks. What's something that banks do? Well, one interesting thing about banks is that conventional banks are the largest purchasers of whole life insurance. Now, you can verify this by looking up BOLI, B-O-L-I, bank-owned life insurance. Commercial banks are the largest purchasers of whole life insurance. So here's the appropriate question after that. Why? Why would banks, and this is so interesting because there are so many folks out there that will tell you to park your money, to set it and forget it, and we already see that banks don't do that. Deposits are a liability. Loans are an asset. Remember that when you own your own policies, or remember that when you're vetting this idea of becoming your own banker, and you're considering what it would look like to own the policy, to leverage the cash value in that policy for your need of finance. Banks look at deposits as liabilities, but loans as assets. Many of us need to change our thinking, grow and expand our thinking to understand that and to value that. So banks are the largest owner of life insurance. Why? All right, so why? So what if we just cut out the middleman? If banks are making bank, why not cut out the middleman? If they're buying whole life insurance, what if we considered cutting out the middleman and just us directly going to these insurance companies or calling up your appropriate professional, 828-817-4223, durhamtalents@gmail.com. Shameless plug there. That's what I'm here for. I'm looking for folks that want to become their own banker. I'm looking to be able to help you speed up your learning curve. I'm looking for us to be able to have dynamic conversations where you can have properly structured whole life insurance policies for your need of finance, structured for what it is that you're doing and what you want to do. That's what I'm here for. That's what I'm doing. Let's have a conversation about what that could look like for you. But what I'm saying is, let's cut out the middleman. Let's cut out these commercial banks. And what if we just directly went and bought whole life insurance policies from these mutual life insurance companies ourselves? And what if we enjoyed the access to capital, the compound interest, the hedging against inflation, the hedging against litigation? What if we could provide for a tax-free transfer of wealth to future generations, and on and on and on? And I could talk about the characteristics, and I have talked about the characteristics of whole life insurance just at face value, let alone if we practice the infinite banking concept with these policies. So what if we funded these policies ourselves and accessed the capital in these policies ourselves for our need of finance and cut the middlemen, i.e. the commercial banks, out of the picture? Now, what do you suppose that would do to your profitability? If you're a household and you're conventionally financing your vacations and you're saving up for college, let's say, or you're setting aside money for retirement, or the vehicles that you have parked in the driveway, or the house itself, or business acquisitions, equipment, whatever it is that you're already doing, what would it mean for your bottom line if you were the one financing those things for yourself? I would imagine that it would be better and more optimal. Now, conventional wisdom says what? Conventional wisdom says to conventionally finance, to pay cash, to save 3 to 6 months for expenses, pay off the mortgage early, pay off student loan debt, get out of debt in general. And I'm not saying yay or nay on those. I promote the idea that you can become your own banker. So you make your own financial decisions. I'm sharing my experience. I'm sharing my knowledge. And what I would say is the beautiful thing about becoming your own banker is you have the ability of both. So if you've decided you want to get out of debt, the only thing better than getting out of debt is getting out of debt and getting the money back. Did you hear what I said? I know. If you're hearing that for the first time, it's weird. It's strange. It doesn't even necessarily settle in your mind right away. I know the feeling. What if you could pay off your debts and get that money back? You have a car finance. What if you could pay off your car and get the money back? What if for the rest of your life you bought cars the way that you were going to buy cars and you got the money back? What if you could save for college and get that college money back? What if you could pay for a child's wedding and get that money back? What if you could take a wonderful family vacation and get the money back? Would you take better vacations? Would you take longer vacations? Would you take more of them? Right? The 3 rules of banking are pay yourself first, pay yourself with interest, and get the money back. Recapture those dollars. Recapture that money. Recapture that capital back into your system. Now, if you're still trying to wrap your mind around that, again, we're just having one conversation right here. Read Becoming Your Own Banker by R. Nelson Nash. Dive in on the information of this channel, and of course, get in touch with me so we can have a conversation. But those are the things that conventional wisdom say. So again, if you're pursuing those things, fantastic. What if you could do those things and get the money back? Because you become your own banker. Because you don't abdicate financing to someone else. Whatever your household is doing, whatever your business is doing, whatever you're doing as an investor, if you're an investor, what if you were financing those things and you were the one that was becoming profitable by financing those things. So do that thing and control the financing. So what I believe the solution to the overarching problem, because so many people want to talk about a rate of return, and so many people do want to talk about how to maximize your return on investment on a sliver of what we're doing, when not evaluating the environment that we're operating in, not evaluating the entire cash flows that come to us and that leave us. Again, what if we could do the things that we're going to do anyway and get the money back? That's what we're talking about here. Becoming your own banker. Look at what banks are doing. Their deposits, they treat as liabilities. Their loans, they treat as assets. Well, you can do that for yourself, but you can be the one that owns and enjoys the tax benefits. I'm not a tax expert. I'm not making investment advice, but a death benefit transfers tax-free. A death benefit pays out tax-free. That is a tax-free transfer of wealth to future generations, heirs, beneficiaries. Furthermore, because I'm not just trying to focus on that, the living benefit is that you have contractual rights of access to your capital in known interest environments. And policy loans are 100% tax-free. So the control, the profitability, the terms and conditions, what if you could be the one to enjoy that? So I hope that this has sparked your curiosity. Don't do business with banks. And I hope that it will encourage you to read Nash's book, to dive in on the information of this channel. And of course, we can have a conversation about how you could implement the infinite banking concept into your household, your business, and your investing. And to do that, you can reach me at 828-817-4223, or you can email durhamtalents@gmail.com. This has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care.
Hey, you. Don't do business with banks. Get out of here.
Oh my goodness. Is that funny when you laugh at your own laugh? I just laughed at my own laugh. I laughed. It sounded funny to me, the guy that did it. And then that made me laugh differently. Oh my goodness.
Don't do business with banks.
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 Don't do business with banks. You can cut that out. I'm just talking to myself at this point.